Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital. Today's topic is on assessing the success of reopening the economy. We've had some macroeconomic data that has surprised to the upside. In particular, I want to highlight we've had some new orders that have come in from the regional Fed surveys, right? These regional Fed indicators, the new manufacturing orders seem to be ticking up. And we also had retail sales in the month of May that surprised to the upside. So we want to look at the data to try to objectively determine how good news these pieces of information are. Maybe they're the start of a bigger, broader trend. Or, maybe they're not. Now, the U.S. consumer, of course, is terribly important to the U.S. economy, right? Somewhere between 65 to 75% of GDP is due to the U.S. consumer. So if we're talking about the success of reopening the economy and what it means for the growth of the U.S., we have to focus on the consumer. Now, we also have to be pragmatic, right? Most of the consumption goods in the U.S. are imported, right? And so I like to look at a number of the high-frequency metrics to try to track these goods, right? Whether it's the barge activity that's coming across the oceans, or whether it is the what's called the container count. These are containers lifted off the barges at the largest U.S. ports. That's going to be Long Beach and L.A. for the U.S. And then also the railroad activity, right? Once the material, right? Once these consumption materials are unloaded in Los Angeles, they have to be transported across the U.S. And that's where the railroad comes in and the semi-truck activity and so forth. So we're going to look at some of this information today. So let's go ahead and jump right in. We're going to start with what's called the inbound container count. All right. Again, these are the containers that are placed on barges and shipped across the ocean. All right. Now, what we can see at the very edge of this chart here is the last couple of months, these things have ticked up. All right. Again, that's consistent with the bounce that we saw in retail sales, that things look like they might be picking up a little bit. But what I really like to look at in this chart is the black line here, the 12-month moving average. And the black line seems to be rolling over, right? Again, we look back in history. This data series goes back to January of 96. We look back in history and we don't see this rollover activity very often. And when we do see it, it's not good news by any means. But again, the box down here in the middle tells the story here. The U.S. is a consumption-based economy. The consumption goods are imported, and the two largest ports are L.A. and Long Beach. That's why we track this information so closely. All right, so at first blush, this looks to be a good thing, right? And it's very similar to the equity markets, right? When we got the May retail sales numbers, they surprised on the upside, and equities had a huge day, right? Great news, the economy's reopening, the virus wasn't as bad, but yada, yada, yada. Man, might have got above our skis, in front of our skis on this one here, folks. Because if we go back, I'm going to just show you another version of that same chart. Year-over-year changes, all right? Year-over-year changes in these container counts. Look at what's happened. The last 2 months, it looked like they bounced a little bit, but on a year-over-year basis, this thing continues to slide. What the hell's going on here? Well, every year at this time, we tend to get a tick up. We got all excited about the May retail sales numbers, but every year they tend to tick up right now. And so the fact that the May numbers improved from April, well, they tend to darn near every year. So if we look at this and reflect this seasonality, that's a term for it, and we reflect this seasonality in something like a year-over-year measure, let's go back to that chart, a year-over-year measure, we see that this thing continues to melt. What looked like good news, what looked like the economy reopening, looked like the consumer picking up faster than we originally thought, really didn't happen, right? We got some smoke and mirrors going on here. And also notice here, the way this thing's melting, it started to melt long before the virus here, people. Notice back here in January of 19, it's really been melting since then. And that long, slow melt, actually, we've seen it before, unfortunately, going into the 2008 slowdown. The consumer was already starting to take a break back long before 2008. They were starting to slow down. So sometimes I refer to the coronavirus as like your ex-husband or ex-wife. Right? It gets blamed for a lot, and deservedly so. Right? This is the worst economic slowdown in history. That's not a small statement, right? That's a meaningful statement. Yet it gets blamed for too much. We've had some concerning trends that actually started long before the coronavirus. And the slowing consumer was one of those trends. All right, but it's not just in the consumer count metric that I wanted to show you. Let's take a look at then the railroad activity, right? Remember, the barges come in, we unload the barges, and then we have to ship across the country. All right, so let's look at the railroad activity to see what's going on there. This comes out weekly. I really like this one because it's so high frequency, right? Every week. And what do we see here on railroad activity? The so-called bounce in consumer, the euphoria from reopening the economy? Really? Really? When do you think stores would be starting to stock up, starting to order, increase their orders, if they were really witnessing such a thing? Look how long this thing's been melting. A long, long time. And you can see, the last update here was June 12th, right? It's just lagged 1 week. And this thing just keeps going down in the month of June. So even though the May retail sales ticked up, they do every year. They do every year. We gave it way too much credit. Now, the final chart I want to show you here is another version. All right, it's same information. I'm just repackaging it. This is what's called a proprietary measure, which really means it's just a homemade, right? And in my warped mind here, I tried to take that previous chart and give me a more meaningful indicator. But it's the exact same information. I'm just slicing and dicing it differently. So what we have here is again my version of what I call a railroad activity measure, again from the weekly data. And here we go, where the metric goes from +1 to -1. All right, and you can see each one of these dots here on this chart is a weekly observation, and we have been slowing for a long, long time here, and we continue to maintain these low levels of railroad activity. And again, we've seen this before. Obviously, that's a 2001 slowdown. Here's the 2008 crash, crash, I guess is an appropriate word for it. This was what's called the energy recession in 2015. All right, the economy really slowed in 2015. We avoided a recession, but you can see the consumer. The consumer also slowed dramatically in 2015. And then, of course, we have some previous recessions on this chart as well. This is just, again, another way of looking at the same information. It's just a metric I put together. So, we had this huge equity rally, right? We rebounded 35 to 40% from here. And at first I was excited about it. I was expecting it. I was excited about it. But, things have gone too far, too fast, right? And we've really gotten to this nuts territory, right? There's an old tale in investments that says it's the boiling frog. You're probably familiar with it, right? If you take a frog and put it in boiling water, the frog will immediately jump out. But if you take the frog and put it in a pan of tepid water and you slowly heat the water, the frog will actually boil itself to death. I don't know if it's true or not, but that's the tale in investments. I think we got a little bit of that going on right now. We are just so excited about every good piece of news that comes. And remember, our base is so low, right? Coming off April, the base of everything is so low. We hear airline traffic's up 20%. Wow, that's great news. Until you stop and look, and the airline traffic is still terrible, right? The airlines are still a long way from being profitable. That same story can be applied to a number of things. Again, the problem is we have such a low base in April that all the numbers just look huge. And as we're seeing in the retail sales, what the market got excited about, we really shouldn't have, or certainly not nearly as excited as the market got about that information. The retail sales did improve to the upside, but they always improve due to seasonal effects this time of year. So it would be wise for everybody to slow their roll a little bit and really look at the fundamental data to see if it's actually as encouraging as it might seem at first blush. All right. So that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.